I think that this is eventually going to level off. We'll probably trade down another couple of percent below today's low before it's over. It's kind of tricky because the S&P looks like it wants to hold its 200-day moving average support while the Nasdaq has broken through it. So maybe we're just in for a period of aggressive tech underperformance while cyclicals perform. That wouldn't shock me at all. But in general, I still wake up bullish. The S&P is still up. What is it up on the year? Let me find it. There she is, up about 6% on the year. Could go either way from here into the end of the year. I wouldn't be shocked if we went up 10 or 12% before it was over. I wouldn't be shocked, I guess, if we traded unchanged. So the market is definitely going to be challenged by this sort of change in Fed expectations.
Welcome back to Capital Cosm, guys. Today we've got Tony Greer on the show. Tony, thanks for making your maiden voyage on Capital Cosm.
I'm happy to, Danny. Thanks for having me on, man. I'm a fan of the show.
Yeah, we nailed this interview timing. I mean, things seem to be falling apart, but really interested to get your take on what's going on out there in the markets. But before we do that, I'd like to kind of introduce you to my audience. So if you don't mind just taking like a minute or two, just kind of introducing yourself. Who is Tony Greer?
Yeah, so I'm an independent market analyst. I write a newsletter called The Navigator that I publish 3 times a week. And I have a Slack channel that is filled with a bunch of my upscale subscribers where we talk about markets all day long. And my intention has been to sort of democratize the market message to everyone that should have their money in the markets, right? I set out sort of as the news, as the foundation of the general news cycle changed to something where there were a lot more independent journalists. I broke off from working at investment banks in 2016 and wanted to launch a similar product, but for finance, because I saw the world changing that way. And I felt like there was going to be a real opportunity for independent market analysts. I saw a few popping up around me, and that was something that I really wanted to do, all in the interest of kind of helping people and showing them which way to look in terms of financial markets if they don't have an idea. So that's what the Navigator is all about. It's about navigating the markets on a aggressive basis and showing people where the risk is. That's fair.
Yeah, we'll have the link to that down below, guys. So be sure to check it out. So Tony, let's just dive right in. What is, I mean, I ask this question to everyone, but what is your overview of the economy right now? Obviously, the markets have tanked, but they seem to be in a bit of at the very moment of this recording, they seem to be in a bit of a dip buying moment. But what do you see going out there? You've got the yen carry trade out there as well. That seems to be the catalyst behind all of this. If you could explain that to the audience as well, that'd be great.
Yeah, so the yen carry trade is definitely at the epicenter of the sell-off, along with a few other backdrop items like the bubble that we got to, and NVIDIA was a direct overlay with that. The yen carry trade. So what happens when Japanese have interest rates at 0? Traders will go ahead and borrow yen as their funding currency and sell yen and buy dollars with the funded currency, and then buy stocks or buy risk assets with the dollars that they funded for nothing via the yen markets, right? So what happens when the Japanese raise interest rates, people tend to not want to roll over that debt and not refund for higher rates. So what happens is their bonds crash, the currency crashes, and it sends a risk tremor out through the markets. The Bank of Japan raised rates because dollar yen was rallying. Their currency was getting beat up. They had to reverse that. So they did that very aggressively, and dollar yen went from 160 something down to 130 something, if that's fair, roughly. So that type of volatility in the macro markets against the backdrop of the U.S. rates market is, I think, why we're dealing with this volatility today. So to set up the U.S. rates market scenario, we basically pivoted to a weaker economy, Fed cutting rates scenario in a very short period of time when the whole market was still positioned for inflation, tech outperformance and the whole thing. And so when the interest rates moved as aggressively as they did in the last 3 sessions or so, you have the curve steepen all the way to 0 from a point where it was around -30 or -40 basis points. So that all of that action kind of sends a signal into the markets, spikes the VIX, stocks sell off, and that's the very rudimentary explanation for what's going on right now. And I can dig into whatever corner of that you want to follow.
Yeah, just really quick. Is this a long-standing shock or just kind of like a just like a kind of like a shock and awe type of effect where we just kind of like see the effect of a 25 basis point move in the in the 10-year at the yen? What do you think? Is this going to be sustained or no?
Danny, the way I look at this is markets behaving beautifully. This is perfectly efficient markets, right? When the Bank of Japan breaks up the poker game of zero interest rates by raising interest rates, the poker game has got to get broken up and everybody has to go home. Everybody takes their chips back and goes home. That's what we're seeing on the screens, right? Everybody was leveraged into that yen trade, leveraged into the stock market, leveraged into tech, leveraged into semis, leveraged into Nvidia. And when the bubble bursts and the liquidity goes away, those trades stop working. And that's a perfectly fine function of the markets to me. So I do think, look at that. Let me put it this way, Danny. I still wake up bullish. I'm very bullish today on this dip in equities, and I think it's going to present a massive buying opportunity. It may not be today, it may not be this week, and I'm going to try to follow it really closely, but we'll know when we see the whites of their eyes. That's for sure. If there's one thing that I have sort of a skill that I perfected from staring at the screens for 30 years, it is to figure out how to observably see the whites of the seller's eyes and to understand that when the panic hits the tape, that's when you want to be buying. And I think, the VIX in a 12 sigma move, a really, really distant tail event today,
Right.
spiking to 50 with the S&P down. Jesus, I don't even know what percent it was down, 4%, 5%. That's an opportunity, right? There are funds out there that are long only funds that are definitely just going to come in and buy this market on dislocations like today. In fact, they're probably the only buyers today and the reason that we're not down 10%. But yeah, I think, Danny, that this is just an adjustment. Market's got to adjust to the Fed move. The market's got to adjust to the fact that we no longer need that high inflation portfolio. We're probably going to switch to more cyclical names outperforming now, like gold miners, home builders, utilities, industrials, things like that. Whereas just 2 weeks ago, the only game in town was the NASDAQ, semiconductors, and Nvidia splitting 10 for 1 and still going up. So we had to work off of that bubble. There was a beautiful sentiment signal at the top of the bubble where Jensen Huang, the CEO of Nvidia, while he was making insider sales, was also signing a woman's breasts as like an autograph type of thing. And if that's not a market topping sentiment, which
That was back in June, right? I remember that meme. Yeah.
We identified that real time. We were like, okay, I don't know if this is the sentiment that causes the exact top right around now, but it's got to be around here somewhere if this is going on. And sure enough, the market had about another month of upside, maybe another couple percent, and then backed off pretty hard, as you see. So, I think that this is eventually going to level off. We'll probably trade down another couple of percent below today's low before it's over. It's kind of tricky because the S&P looks like it wants to hold its 200-day moving average support while the NASDAQ has broken through it. So maybe we're just in for a period of aggressive tech underperformance while cyclicals perform. That wouldn't shock me at all. But in general, I still wake up bullish. The S&P is still up. What is it up on the year? Let me find it. There she is, up about 6% on the year. Could go either way from here into the end of the year. I wouldn't be shocked if we went up 10 or 12% before it was over. I wouldn't be shocked, I guess, if we traded unchanged. So the market is definitely going to be challenged by this sort of change in Fed expectations.
Yeah, one of the effects of this yen carry trade unwinding is a weaker dollar and a stronger yen. Now, there's a lot of talk about the Fed cutting rates. The probability of a Fed rate cut is essentially 100%. Even before any of this happened, right?
Yep.
50 basis points is now at 97.5, according to the CME Fed Watch tool. The question is, though, with a weaker dollar, doesn't it make it a little harder to cut rates now?
The Fed is always going to manage expectations. The market is always going to react, and then the Fed will kind of be able to ease into whatever they need to do. I'm not one of those guys that ever says, the Fed has lost control. Like I think that's nonsense. I think when you control interest rates, money supply, excuse me, and interest rate expectations, you've got the whole world in your hands there. So now the Fed signals towards tightening. The market anticipates what it wants to anticipate, 50 basis points as a lock almost. And now the Fed's got its rate cut on the tape, and they didn't say a word, right? Markets reacted, dollars lower. And this is why you have what's called sell the fact news events,
Right.
right? Because the whole market has reacted already. The whole market has reacted to the change in the Fed's stance, to lower rates, to no inflation, to a weaker dollar. It's all out there. It's all done, right? So what happens is we'll get to a Fed meeting in September. They'll cut rates and the market will freaking explode. Because they'll say, okay, lower rates, easier money, buy technology, buy the growth stocks aggressively.
Japanese treasuries, right?
Yeah, yep. And those trades are all likely to work. I'm very US centric lately, Danny. It's been a really, really exciting year and a very, very tradable year in the US equity market. So that's really where I kind of butter my bread.
Right. Do you see this Iran attack having any sort of impact on the markets at all?
I feel like $73 oil says not much. I honestly would have, as I read those headlines like you did, I'm like, man, oil's got to catch a bid here if they're going to talk about retaliation, and oil's still being de-risked, and
Right.
so that's one thing where no matter what we say about this risk in the Middle East, the market has not, nor has it ever had any respect for any Middle East conflict almost at all. Right? Almost at all. Like the Houthis are blowing up Saudi rigs and things like that. They're attacking them. There's no change in the oil price. Where Iran is going to go attack Israel now, there's no change in the oil price. So I got a feeling that most of the stuff that makes it through the headlines is kind of irrelevant saber rattling. You know what I mean? Like I don't even think that there's really anything going on, but we'll see. If anything happens that moves the markets, I'd be shocked, literally shocked.
Right. So it's not being priced in at all. At least it doesn't appear to be so.
Yeah.
If you were the Fed, would you be happy about this cooling off of the market? I mean, you just kind of alluded to it before, right? The market was heating up quite precipitously. Now with this sell off, it seems like it plays right into the Fed's hand, does it not?
Yeah, they kind of got what they wanted. They took a little bit of the hot risk out of the market. They deleveraged guys that were really, over their skis with positions because the market's been performing so well. As soon as we pivoted into that rate cut scenario, this Russell 2K took off like a bat out of hell and rallied like 10% in a week. And then just gave back 7% of it. But those are the kind of reactions that you have to expect to lower interest rates. And we're probably going to see, as long as the curve doesn't just jump out of the gym all in one shot here and go positive and keep going positive, I think that the market is going to be totally tradable. And it feels like what it actually feels like, if you're the Fed, I guess the question was, if you're the Fed, are you happy about this? And at some point, it just proves that the markets are working just fine. You need pullbacks like this so that you don't crescendo into a parabola and then crash.
Right.
So it kind of, this move is perfectly fine with me. And in my opinion, aside from the VIX print, there's really no other signs of like heavy stress or deep panic in the market. It's all totally tradable.
What would get you to change your tune, though, Tony? Like, what would you need to see to shift the other way?
I guess if the treasury market keeps rallying with reckless abandon and can't find the top, right? And that would be a signal that rates are going lower, that the Fed is maybe even more behind this economic weakness that we've been getting than we think. That might scare the markets and cause another sell-off, especially if that materializes as the indices sort of maybe curl over below their 200-day moving averages. Like I said before, the NASDAQ broke it. The S&P bounced off it so far this morning, but we're certainly not out of the woods yet. If things started to break down technically further with a continuation of the Treasury rally and lower rates, that would tell me that more length has got to come out of the NASDAQ and more length has got to come out of semis and out of NVIDIA and things like that. So I can see that, not my likely scenario, but a possible one.
Gotcha. If you can kind of like pinpoint a time in history where, this might not necessarily repeat, but also, but seem as if it rhymes, right? There's that old saying from, who was it? History doesn't repeat, but it certainly does rhyme, right?
Yeah.
Um, is it 1987? Is it 2015? Is it, what would you say? Like,
So when I look, if I look at the VIX and look at other recent spikes like this, we had the 2015 VIX spike when oil collapsed, right? We had the Volmageddon VIX spike in 2018. Then we had the um, post US bioweapon launch into the lockdown VIX spike. And over the last 10 years, those were the last one, two, three times that we've seen the VIX spike to levels like this, right? If you had stuck a bid in any of those times, you did great, right? That's the one takeaway for me, right? I look at those and I know that in 2015, 2018, and in 2020, I was getting really good opportunities to buy cheap S&P, right? We knew what the culprit was eventually, right? You figure out what the sell-off is about. You read the signals on the screens, whereas you see the volatility spike, you see technical breakdowns, you see the tick index register massive, massive downside extremes, which means that there is agnostic bid hitting across the NYSE. And when you look back at those moments, you can usually deduce that while it looked scary real time, like it does now, several months from now, you're going to be saying, man, we could have bought that freaking dip when the Fed changed policy and the curve spiked. Man, we could have bought that dip down to 5,300 S&P and we didn't do anything. And we will be doing that in 2 months. I guarantee it. So
nice.
that's kind of what my posture is. I do believe that this is a totally tradable pullback. We know the reason. We can kind of pinpoint a few of the direct causes of it. And eventually the selling is going to stop. Right? Where I don't feel like we're at much of a point where lower prices uncover more sellers. I think we go to lower prices and we start running into plain vanilla buyers that are like, we buy the S&P 10% off the highs as a practice. So that's kind of the kind of the formation that I'm looking for, Danny. I don't get terminally bearish at all.
Gotcha. One thing we've seen occur over the last week or so is the uninversion of the 32 spread. The 10-2 spread is yet to invert uninvert last time I checked. What's your prognosis on the 10-2 spread? And for those who don't know, the 10-2 spread is kind of like the leading indicator to determine whether or not we're in a recession or not. But I'll let you take that one, Tony.
Yeah,
What do you think there?
sure. That spread had been depressed in negative territory for a longer period than we've ever seen it. That is supposed to be the recessionary prediction. So it just sat there and predicted recession for the last 2.5 years.
Yep.
What that did though was create a great environment for equities. But I guess to stick to the curve conversation, the steepening of the curve is what indicates a change in Fed policy stance, and the market knows that it has to react to that, right? Whether it's a rotation of sort of style box form or if it's a all asset class sell off, the tape is going to react to the steepening of the yield curve because it means a change in policy by the Fed. So what's interesting is that we saw some capitulative type moves in the bond market today where, the treasuries have been rallying, rates have been nosediving. And then today we see a new low on the board in rates, and now rates are positive on the day. Treasuries are negative on the day now. To me, that's the type of reversal move, right, that you look for. The curve was minus 10, minus 20 basis points over the last couple of weeks. Today it trades to flat, back to minus 10 basis points, right? That's extreme type of action. And I'm not talking extreme levels. I'm talking like at the extremes. That's the type of price action you see when markets turn. So I could see a scenario here where the treasury market found its peak, sells off a little bit, indicating that rates are not going to go much lower in the short term and that we've kind of adjusted to where the economy is now in the rates market, and stocks will get back on their feet, probably cyclicals first. So that's the kind of way that I'm looking for it to play out from here.
Are you in the market for gold and silver? Then if so, please consider Miles Franklin. They are my gold and silver dealer of choice. So not only do they have super competitive prices that you're going to have a really hard time finding elsewhere, but then they also have top-notch customer support. I know Andy Schechtman, the owner of Miles Franklin, top-notch guy. I wouldn't be recommending them to you if I didn't have faith in their product mode. What you really want to do, however, you want to email them at info@milesfranklin.com, and you want to say that Capital Cosmos sent me in the description line, because when you do that, you can get access to their special pricing sheet. You want to get that special pricing sheet because you're going to get special prices that you won't find on the website itself. So email them at info@milesfranklin.com. Tell them that Capital Cosmos sent you, and you won't be heckled with spam emails, etc. There's no commitment necessary. I promise you that. And with that said, I will let you get back to the video. Right. You mentioned early on in the interview that you see, I mean, you just mentioned it now, actually, cyclicals, will be the outperformer moving forward here, including gold mining stocks. Before we talk about gold miners and miners in general, I want to get your opinion on gold and silver at the moment. While they did dip a tiny bit, it is, again, a tiny bit relative to everything else. They seem to have been the least impacted from this sell-off. So what's your view on gold and silver moving forward? Do you see more of a correction for them kind of moving in tandem with any potential sell-offs in the market, or have they kind of decoupled? Do you see that?
I think that the trade is to be long gold, right? I think that that's the right trade, right? We're trading on the implosion of fiat currency everywhere due to the West's penchant for massive debt. The trade is to be long gold, right? Gold is breaking out technically with that. Gold is being bought by central banks, and I'm not a dollar as reserve currency maximalist, meaning like, I'm not one of those guys that demands that the dollar remains the reserve currency forever. But with the conversation going on between Russia and Saudi Arabia and about 15 or 20 other BRIC countries trying to trade commodities outside of the dollar, to me, all of that is really, really bullish for gold, right? So starting with that, I think that's the trade. The reason that gold is down a little bit today and actually had to go down today is because it is an asset. And today there was a deleveraging, a de-risking, and a pretty much all asset class sell-off outside of the bond market, right? What was I talking about?
You just said it was an all asset class.
Yeah.
I just want to know if do you see a decoupling happening with gold?
That's right. So gold, I'm sorry, I had to get back on the right track. Excuse me. So silver had been following gold. Silver to me is the rich man's casino, right? Silver is not the trade. To me, silver is sort of half an industrial metal, half a precious metal. And maybe it does get going and break through these highs around $30 and go to 50. That will be a complete manufacturing of kind of the chase gold trade. To me, the trade is in gold. So I'm staying long gold. I'm hoping that gold dips a little bit more, but what happens is gold becomes a line item on days like today. And when every other line item on a portfolio manager's pad is getting blown out, he's going to absolutely sell some gold to participate while it's up, to capture whatever profit he's got in that trade while other things fall apart. So I think that you want to buy gold back into technical support at 2,200 again. Like I said, I think that's the trade. Silver is still proving that it could have been just a true trip to the range top at $32 and a false breakout. So that's why I'm not really as excited as silver. I haven't traded it. I don't chase it. I kind of just spectate. And if everybody wants to blow their brains out trying to push silver to $50, go ahead. I'll be long gold instead. So that's kind of my look on that. And the other kind of view that I have is that gold miners, they may be going along for the ride. They'll probably do okay. There's no way they're going to outperform your gold position, in my opinion. So I would stay long gold before I'd move to the miners. There's still a zillion and one ways that the miners can screw up the price of gold going up. So that's
which has been the case over the last 10 years or so, regardless.
They have been dramatic underperformers, and they continue to underperform. Is that fair?
Yeah. Yeah, right? I think the only case where we did see an outperformance from the miners relative to the actual metals was 2020 all the way up until 2021, mid 2021. I think that was pretty much it.
That was the Great Rotation. That was when we had 9% inflation. The Fed raised rates and we took the piss out of the technology market and all the flow went into hard assets. That's exactly that trade.
Yep. What about energy? You mentioned the price of oil really not moving in terms of the narrative going on in the Middle East and everywhere else. Still saying around $72, $73. What's your view on oil and gas and energy in general?
Um, Put it this way, I remain bullish to stocks. I don't have directionally a bet on the commodity at all. I think that's really hard to do right now, and I'm the first one to jump into an oil trade. I am totally comfortable with a massive amount of oil risk on my pad when I know why I have it on. I don't see that opportunity at all right now. If you ask me the next $10 in oil, I'm a finger in the wind. I have no idea guesser on that, right? My one view, I guess, that I have is that energy stocks, exploration and production, oil services, those are still undervalued versus the S&P. They're probably still too small a percentage of the market versus the S&P. I think that during the Biden administration, they all shrunk their capex to zero because they've got an unfriendly president in the White House to their commodity. So what they tended to do is just kind of sit this administration out, right? They cut capex down to zero. They just try to get by. They're getting by very well because we're still pumping oil like gangbusters, despite the Biden administration's attempts to slow us down. We're still like 13 million barrels a day in pumping. So those companies are set up to succeed really well. And I get massively bullish in the case of a Trump administration. Like, I think that it takes the price of oil down a little bit, but I think that oil stocks get back to work. They raise their capex. They probably lower their cost of production and they get set up really, really well for success. So that's kind of one of the trades that I have in the back of my mind, if
Yeah,
that's fair.
yeah, definitely. What other differences do you see between a second Trump administration versus another Harris or Biden or Harris Biden or Harris administration?
Yeah, well, the Harris administration is scary. Like, I don't think that this sell-off is because of that, but it's direct correlation to her getting number one, the nomination, and basically taking over in the absence of Joe Biden after he was just cooed out, right? So the market, like, I don't think that she's really the reason that the market is selling off. I think that if she was actually being determined as becoming the front runner in the polls, that the S&P would shit the bed, right? She's left of Bernie Sanders. She's not doing anything for capitalism, right? I mean, most of her axes to grind are on the social, scale, which is probably much better for the markets. But, she was talking about, capital gains taxes and all kinds of stuff that is very, very unfriendly to the capital markets. So I think that if she ever pulled ahead in the polls, I think that the deep state probably has her kind of trying to poll in line to pull off this hocus pocus. Like, oh, wow, look at this. She's just as good a candidate as Trump. We got Biden out of the picture. Harris is clearly going to be a better candidate than him, and she's going to give Trump a run. That's nonsense. I don't think that she could fill a junior high school gym if she showed up in her hometown. So she's really not polling that well. They're just trying to tell you that. So just in case she wins, it doesn't look as batshit crazy. So that's my opinion on that. But I do think that the market was rallying because of a potential Trump administration. I think that there will be upside if he does get elected again. And I'm very scared that the natural outcome is not going to happen anyway. So it doesn't matter.
Gotcha. So let's say we do get a second Trump administration. What does that mean for tech and growth and the whole rotation trade from growth to value?
I think growth probably comes out the winner again, quite honestly, because if Trump is going to theoretically lower rates in the front end, steepen the curve when we're dealing with the inflation down the road, like he did in the first administration, then it's hard to see if he's going to pin the front end of the curve down. It's hard to see how tech doesn't, wake up from this, especially from this dip, and start performing again. So I kind of get bullish that same cocktail that the market was rallying on before this de-risking coming back again, because I have a feeling that was shades of anticipating a Trump admin. When it was Trump polling versus Biden, there was really kind of no contest. So it looked very much like Trump would be a clear runaway favorite, at least. And then, like I said, they pulled a coup, they switched candidates without any voting and blah, blah, blah. Next thing you know, we've got, a neck and neck race. So we'll see. But I think that a second Trump administration is going to be great for the markets. He's definitely going to cut regulations. He's going to cut the size of government. He's going to lower the front end of rates in the curve. I mean, he's a market friendly guy. The stocks are going to go up. The S&P went from 2080, like 2100 to like 3400 under his administration. It almost doubled. That's going to happen again if he gets elected.
Gotcha. Speaking of growth and tech, let's shift over to Bitcoin. Bitcoin has, it gave out a lot. I mean, it's one of the bigger losers over the last couple of days, but it does trade 24/7, right? So you can look at Bitcoin as a leading indicator for growth and tech, and they kind of follow behind it because it trades on the weekend, it trades at night, et cetera. So it just has more opportunities to kind of capture what's going on in the space. Do you view it the same way? Do you view Bitcoin as the leading growth indicator? And then as well, what do you make of the current price movement? It has have we peaked for this cycle already, or is there still room to grow?
Yeah, I have a very direct response to that. The only other thing that's open 24/7 are casinos,
Hmm.
right? That's what Bitcoin is to me. It has always been that, right? It has always been a levered bet on US risk assets, as you said, most closely correlated to tech and the NASDAQ, right? So that's absolutely accurate. I think that if it's a levered bet on risk assets, that it's probably, I have to say, I don't get terminally bearish on it. I think it's going to find a level and hold in there. The thing that it has working against it right now is the technicals, right? Like no matter how you slice it, there's a bad false breakout above 70K. There's a failure after that. That I've seen that mean the end of rallies before. So there's that potential. It still seems like there is the need for people that want to store their money and wealth outside the system. So it seems like Bitcoin is a good trap for that and continues to capture sort of a little bit of that portion of the economic flow. That's just what I think. I could be wrong. So it's not like the number one thing on my radar. The breakdown doesn't shock me with the NASDAQ breaking down. When the NASDAQ levels off and the S&P levels off, Bitcoin is going to level off, and then there'll be a trade from 50 to 65 or 70, which is great percentage returns. And especially if it happens fast. So I do see that, it got the socks knocked off of it. It's closely correlated to the NASDAQ. Risk is on its back. Bitcoin's got to go down. And yeah, and it's total casino that's open 24/7. That's why I don't trade it. Like I literally could not stand in 2020 when I was on the line for bagels at the bagel shop around the corner on Sunday, and I had people texting me, "You see this thing? You see this thing?" And my only reaction was, dude, you're going to be wishing it was closed on Saturday and Sunday at some point in the future. I promise you. And we're probably there, right? If this thing sells off into the weekend, you're not going to want to be long Bitcoin Saturday and Sunday. That's for fucking sure. So that's kind of my view on it. I do stick my nose out and take swings at it every once in a while. I have a lot of really, really dedicated and very freaking smart Bitcoin investors, traders, and maxis in my Slack channel. And I have a lot of respect for those guys and what they think about the crypto markets. And I kind of lean on them quite a bit because I believe a little bit in what they believe. So it's not really an original view, but like I said, there's a lot of brain power capital in that Slack channels. So I don't think it's something that's going away. I feel like there could be a need for a currency without a central banker. So it seems like it's something that I don't want to root against or have go away.
Yeah, yeah. And another commodity that kind of tracks the growth sector is uranium. Some might say, right? What's your view on uranium? Uranium's been taking quite a bit of a pounding lately. Even before the big sell off, uranium is not doing too hot. It's kind of a wasteland. What do you see in terms of uranium?
It's a really hard market to read because it's like the least transparent commodity on board. I can get more information on coffee, sugar, and cocoa than I can on uranium. And that's why I don't really take big swings at uranium, although I am long the commodity itself via Sprott Uranium Trust. And that's an interesting story because, You look at it, there was tightness in the uranium market. Sprott comes up with this product that does nothing but take physical off the markets. We run the thing higher on the utilities who are price insensitive anyway, right? You're paying for it. Who cares? Um, and we were at the point where there was no offer and no uranium around. And guess what that was? The dead ball high. And that was the high because sentiment got ahead of itself, positioning got ahead of itself. Because when commodity traders hear that there's no uranium around and there's none on offer, they buy it and source it wherever they can and pay whatever they can for it, looking to sell it higher. Right? That's kind of the way a commodity trader thinks. And we just went through this period where there was no uranium and then the price went down. Right. And it was all because of the de-risking that took place. Right. Somebody sold some Sprott Uranium Trust. They all got way too long URA, the uranium miners, the CCJ party that went on for 5 years without a hiccup, and then next thing you know, earnings comes out, the chart breaks down, and the entire sector has a different complexion to it. So uranium, like everything else, is in pullback mode. And, I'm still a believer in that sort of COP 2050 idea that, we're going to be doubling our uranium capacity on a global basis. So I think on the long term, it's kind of I think it's a good long to have in the books, to go for that play where, unless we start producing a lot more uranium, we're going to have a problem. And I think that we have a chance to really, really grow nuclear energy, which grows that market. And I think probably makes it even more efficient and all the more reason to be long it. So I'm kind of bullish. I don't have all the answers in uranium, but I just kind of read the tape and kind of know what phase it's in.
Gotcha. I asked this question to all my guests, Tony. Is there a book that you'd recommend people pick up to really up their investing game?
My favorite has always been Reminiscence of a Stock Operator, Dan, to be honest with you. That's the fictional account of Jesse Livermore. And that's the way I trade. I'm a tape reader, pattern recognizer. And so that book really, really spoke to me. I like the things about the markets that have nothing to do with fundamentals, right? That to me, that's the market, right? I don't care about the economy. I don't care if we're in a recession. I don't care if the economy's booming. It's got nothing to do with the last sale. So that's why I love tape reading and books like that. And so that's one that I've read over and over across the years of my career. And every time I read it, I come up with a new earmark or a new quote that I love. And that's a really good book.
Nice. We'll have to link that down below, guys, if you want to check it out.
Yeah.
Tony, anything else you want to talk about that we didn't get a chance to mention?
Nah, man, Danny, I think we covered it all. I'm really a market generalist. I trade. My job is to keep my clients who are family offices and portfolio managers. It's my job to let them know what sectors I'm bullish and what sectors I'm bearish. And, right now is just a big pivot out of being bullish tech into being bullish the cyclicals, because they're going to back off and then lower interest rates are going to help them as the economy stabilizes. So that's kind of how I'm positioned for the next quarter or so, is to be long things like home builders and financials and gold miners, and not so much tech or any tech at all. And, I still trade this stuff from the long side or whatever, but in terms of positioning for a portfolio, we're moving on from tech for a little bit right now. And that's it.
Okay. Well, I'm interested to get your take, guys. If you agree with Tony's analysis, let me know in the comments down below. And if you don't agree, let me know why you don't agree. Do you think that this was a short-lived sell-off, or that could maybe go out until the end of the week or so, or is it something something more long-term? Draw me a comment down below. Really interested to get your take. Tony, thank you so much for coming on, man. Where can people find you?
You're very welcome, Danny. You can find me on Twitter at TG Macro, and send me a DM if you want to ask me anything. My website is www.tgmacro.com. I've got samples of my newsletter on there and everything else that I put out. And if any of your listeners want to send me an email, it's tony@tgmacro.com. I'm happy to answer any questions anybody has.
Fantastic. If you guys enjoyed this video, give it a like, subscribe to the channel if you haven't already, and follow Tony and all of his socials down below. And with that said, I will catch you in the next episode. Bye, y'all.
Awesome, man. Great job.